There we go. Perfect. So, hi everyone, and welcome to our Green Investments webinar. It is great to have you all with us today. I'm Ella Nicholas. I am Go Green Now's Events and Partnerships Executive, and I will be your host for today's session. So, the conversation around sustainability and finance is obviously evolving very quickly. What used to feel like a niche area is now becoming central to how businesses operate, invest, and plan for the future. But obviously, with that shift, it can sometimes feel quite complex or even overwhelming to navigate. From that, obviously, to our audience, please do feel free to put any questions in the chat, which will be answered via Q&A portion of the session at the end. So today is really about making that ESG and green ESG space feel clearer and more accessible. We'll be exploring how ESG is evolving, where investment is genuinely flowing, and what all of this means in practice for organisations looking to make more informed and impactful decisions. Obviously, and a quick thank you as well to our media partner for today's session, which is Trade Finance Global. So thank you to them. So before we move over into the discussion, I'd like to introduce our speakers for today. We're joined by the lovely Niki Hutson, Sustainability Market Leader for UK and Ireland at Bureau Veritas. We are also joined by Luke Lapointe, who is the Board Director at Capitals Coalition Hub Canada. It's absolutely wonderful to have you both here with me and with our audience today. So before we get into the discussion, I will just hand over briefly so you can each introduce yourselves in your own words. Obviously, Niki, would you like to go ahead and start with that one?
Absolutely, and thank you very much for inviting me, first of all, to speak on this today. Just for everybody's background, so I'm Niki Hutson. I'm a PhD qualified corporate ESG practitioner, and I've got a background in strategy and sustainable finance. I lead our transitional services here at Bureau Veritas for our UK and Ireland market, with close connections with our group, really trying to drive our transitional services with credibility and integrity. Previously, I used to head up climate finance and our climate services at one of our competitors. And I also, which is quite nice to be joined by Luke today, I was working previously for a Canadian-based organisation who I have some great connections still today. Over the last 10 plus years, I've worked closely predominantly with issuers, so that could be corporates or sovereigns, investors and regulators, amongst many others. And that has been across multiple different markets, from Europe to Africa to Northern America and so forth. I've actually been really fortunate and incredibly lucky to also have been invited to speak and host at several COP events and also global climate events. And I'm part of their climate leaders group as well. So I really do live and breathe, which isn't always just about work. Sometimes it's going to events which are about comedy and a little bit more sociable too. But most of my work has been about one thing: how we move from ESG ambition to delivery and maintain our integrity in the process and keep up that partnership approach. And Luke.
Good morning, good afternoon. Thank you, Niki, for the breaking the ice on the introduction. I'm Luc Lapointe, Canadian, based remotely in Colombia right now, South America, so a beautiful place. I started as a lobbyist in Canada, where I did the banking reform and pension reform, and started traveling the world, just to give it a little bit of a context, right? And start traveling the world with the leading group on innovative finance, trying to convince country that official aid is interesting, but there's much more capital available to meet the needs of their economies. In 2014, moved to Colombia, and so I'll give you a perspective from three different aspects. I teach impact in sustainable finance and international finance at two universities in Colombia. So I'll give you maybe that academic, so the knowledge gap aspect to what's happening right now and why maybe there's not as much still as we would like to see in the local perspective as well. Also the practitioner side, so we work with different sectors, the mining sector, the energy sector, and ag sector, different sectors. in trying to get product to market. So we've done social bonds here in Colombia. We've done orange bond as well for different thematics, and also we're right now working on various deals to bring to market. And also the last perspective is more of the monitoring evaluation of these green bond and sustainable bonds. And there's a lot of discussions, but are they really delivering at the other end? Do we have enough transparency when it comes to all of this? Anyway, so I'll bring these perspectives, but again, a pleasure, Ella. Thank you for the invite. Also, Niki, for meeting you, and then looking forward to participate and get some good questions.
Perfect. Well, thank you so much, Niki. And thank you so much, Luke. It is obvious you are the best people we could have approached for this session. You have extensive background, and I'm sure myself and our audience are very excited to hear both perspectives. So I'll move into the discussion section now. And Niki, I would love to start with you first. So, drawing on your experience across ESG strategy and sustainable finance, what do you see as the most material shift in investor expectations over the last few years, and why does it matter now?
A question I could talk on for hours, but a really, really relevant one, and I'll try and keep it as short and succinct and accessible for everybody today. I think the biggest shift is actually something quite straightforward in the sense of investors have moved from rewarding ambition and asking for proof. So following on from the very point Luke just mentioned in his introduction there, really about valuation and demonstrating impact. A few years back, setting a net zero target, for instance, or publishing a ESG or sustainability report was often enough to signal intent to investors. Today, they're getting a lot more direct. They're asking, what does this actually mean for cash flow or risk or ultimately valuation? And these are the sort of conversations which we're having more and more, particularly at Veritas, with our different stakeholders to date. And so ESG isn't really sitting on the side of anything anymore. It's being used directly to finance decision-making. You can see that shift is really taking place clearly across different markets. And I'm sure Luke will be able to add in some of the LATAM perspective as well. But in Europe, where regulation and carbon pricing really started to move forward a little bit earlier, companies started transitioning in a way a little bit sooner. And also there's a good example of where they were rewarded early on because investors could start seeing a credible link, for instance, between the transition strategy, the earnings of resilience, and all of this really showing up when we've undertaken anything what we call a second party opinion. The UK is a really interesting example of seeing where the requirement to disclose and the requirement to actually start, strategically speaking in the right languages to investors is coming more to fruition. And the link to transition plans as well is, one of the most prevalent conversations which we have more and more, and setting targets connected to these, even if financial institutions are like Barclays as an example. So really making sure that climate strategy connected to financing and risk management, they're the sort of conversations and requirements and linkages that investors are wanting to see more today. Elsewhere, and I won't be able to talk too much on, say, the US and emerging markets. I'm sure Luke will be able to speak a little bit more on that per se, but there's a little bit more variation. But that gap is closing. And particularly when we look at the pricing connected to climate risk globally, that the conversations are still generally the same, and the return of investment for investors from acting on climate change is key. One of the big change I think investors are becoming more interested in, and definitely what I've been having more conversations around, is about data. Investors don't just want more sustainability information. They want information that's comparable, that's actually useful for making decisions. And that's where frameworks such as the ISSB matter so much. And technology, investors are looking at ways in which they can start scanning data as well as part of their decision making. And this is actually really important when we look at, say, the use of responsible AI as well, and where investors can potentially use this to help them understand gaps and inconsistencies a little bit more. And I promise I'm nearly finished. Excuse me. So at Bureau Veritas, we're having these conversations very directly about, would, for instance, a transition plan stand up for scrutiny with an investment committee? Is the information we're going to get the investor grade? Is it verifiable? Are they getting the right sort of data reported? But really, what does matter is context. Wherever you are, where capital needs to be allocated, looking at the strategies, the risk. And sustainable finance, it really does demand credibility. It's not just about a good story. So that data does matter. And that's what investors are looking at when they're thinking, how investable are you as an organization? So that's it. Thank you.
Perfect. Well, thank you so much, Niki. That was an incredible answer, in depth. I answered everything we asked. It was wonderful. Obviously, you mentioned that Luke may have sort of more interest and some more elaboratory points on that. Luke, would you like to add anything?
Yeah, no, absolutely. I think that's very interesting, the perspective that Niki brought, and you see the same thing in emerging economies, but at the different scales, right? And I think one of the issue that is big for us in emerging economies is the knowledge gap. So for example, there's not that many universities teaching impact and sustainable finance. So again, if somebody wants to learn, they go to London, they go to the US, and get the concept of how to do this, and they come back to the reality that here it's totally different, right? I mean, the same impact, we're talking about the same finance, the same model. Capital markets are not that big. So again, to issue here or to issue in Brazil or different markets, I mean, the interest rate, for example, you can have a saving account and earn 15% no risk, right, tomorrow. So to issue a bond, a green bond, and hoping for a green premium, right, a lower rates and everything in markets. So why would investor go this way where they can invest in savings and keep their money in easy accounts? So there's two dynamics. I think there's a big knowledge gap, so lack of pipelines of projects that are big enough for markets. So again, in London or US or Canada, you can have these big deals, right? The $500 million, the $1 billion deals, but here the deals are much smaller. So you need, or this lack of capacity to pool these smaller deals, right, at the local level to actually bring this to market and bring an interesting portfolios. The access to market as well is very complicated here, much more complicated here. If you want to issue in international markets, which many do, they go outside, they go to London, they go to Luxembourg, they go to the US to issue some of these bonds, right? Again, in harder currency because you get a lower rate of lending in those markets than you do here. There's many factors right now that are impacting this. I think the demand is much higher. There's much more innovation. People see the impact that thematic bonds can bring, be it the social bond or green bond, or sustainable bond. So there's a big demand side. There's a lack of a pipeline preparation stage. How do you get these to markets, right? The markets are not that big. So again, there's 4 markets here in the Americas. If you look at from Iqaluit to Patagonia, right? There's only 4 big markets that can really count them. So if you issue something in Belize or in Guatemala or in Paraguay or in Guyana, right? What's your market if you're in local currencies? Very small, so hard to trade. The interests are very high as well. So again, it loses that appeals that markets like London have, right? So again, there's many factors. There's a big demand. There's much more. I see much more innovation here in emerging economies. The impacts with a little bit of money you can generate very, very large impact. But I find right now the problem is architecture. We have capital markets that were built for a previous era of as I said, different type of need by the financing communities. Now you're looking for transparency, you're looking for speed, and the markets are not built for this, right? How do you get to market? That's extremely lengthy and costly, and you got to know somebody at JP Morgan, and you got to know someone that's going to get you there, right? For most organizations, this is hard. For corporates that are smaller in emerging economies, not just Latin America, Africa is the same. Call it a problem or opportunities at the same time, right? So again, the demand side is there. The offer side, I mean, it's lacking. I think the preparation to get to markets. The markets are not that big. So again, you're seeing now Colombia, Peru, and Chile trying to merge. You have 3 different currencies. So again, that becomes an issue, right? So again, you can issue in Chile where there's more more capital than here in Colombia. But again, you still have to deal with conversion, right, with different pesos or different monies. So I think that, as I said, for the demand side, there's big opportunities for thematic bonds. People want to issue more of these. Capital markets are very small here. Getting to the big capital markets is extremely expensive. But again, investors are looking for this. So it's not the lack of demand, right? I think it's the architecture that we need to change, and maybe we'll have a chance to talk about digital. And when I talk about digital, I'm talking about regulated asset, not cryptos or the things that we hear in markets that scares investors. But the real digital markets, right? Speed, transparency, easy to get to markets. Right now, it's very human intensive to get to market.
Yeah.
Right?
Yeah, and no, like that's when we're looking at the different types of instruments, it definitely jumps on there. The demand is there, but it's also that capacity and education building part which needs some support. And we definitely see it, when we're coming in as a verifier or an advisory partner for clients in different parts of the world. The type of labeled debt, the type of instrument, whether it's bonds or loans, whether it's through the ICMA, the LMA, and the CBI, like all of that. Also, I think there's a bit of upskilling and education building which needs to happen, and actually allowing that to be accessible. And definitely, looking at the affiliations through from whether it's the trade bodies or through the universities as well, and the local market context, that also can help bridge that gap. But the investor demand, I think, is there. We're just seeing the infrastructure, I think, in different parts of the world as well, which are maybe less mature, starting to come a little bit more into play. It's an exciting time, but there is definitely room for innovation, I think, in the emerging economies for sure.
Lovely. Thank you so much. So, Luke, I'm just going to pop back to you quickly for this one. So it is evident that you have worked across multiple regions globally and global financial systems. So from your views, where is global capital currently falling short in delivering that real sort of on-the-ground impact that everyone's aiming towards?
Yeah, again, back to emerging economies, I think this is where we'll have most impact, where the needs are. But again, there's a lot of a problem of nationalizing capital as well, of getting capitals here to the region. I think when you look at sustainable finance, it represents about 2% of the total amount of money. If you look at the social bond, I think this is interesting, right? Of the $6 trillion market called sustainable finance, that includes a section called social bonds, for example. Most social bonds were never issued by the social sectors or by cooperative or credit unions. I think the issuers are still sovereigns, right, when it comes to these type of bonds, but none are issued by the sectors. We've had a couple of forums last year with the social and solidarity economies, credit unions it's a big sector. Now they're trying to organize themselves into a single marketplace or some kind of finternet, they call it, right? And so trying to connect all these credit unions so they're not as connected as the banking system. So again, we see a lot of capital wants to come here. It's extremely difficult to nationalize money. It's extremely complex. You have to look at different capital market regulation as well that you need to report on. Now even more green taxonomies, right? So and it's hard for an investors, right? What do I report under, right? 600 ESG frameworks, a whole bunch of green taxonomies here in Mexico, in Colombia, and all the regions. Same thing in Africa, a couple of them, right? But none of them have interoperabilities, right? So it makes it very, very difficult for investors to come into the region unless they come in hard currencies, issue in traditional marketplace like London and in the US, which is much easier and there's more sophisticated type of investors, right, looking for these type of instruments. So again, global capital is very interested here, but it's hard because, as I said, you can leave your money in the saving account and do very well with less risky. There's a big demand, as I said, for thematic bonds. But again, it's that connection, right? The lack of connection between capital markets, so foreign markets, like in the US, where there's much money. So of 84% of the capital, only about 16% will flow into the region somehow, right? So again, architecture problem for me, infrastructure is there's no connection between markets, different capital market regulations, right? So it's hard for investors to come in. But I said the opportunities are here, and this is what we're working on, right? And you've also, Niki, you've mentioned reporting these ESG, and investors are looking for that transparency. But it's once you issue it on the London Stock Exchange or Luxembourg, then that's your ultimate connection with investors, right? And then after that, so this is where we're looking at digital as, you know, blockchain again. Sometimes we throw this into the conversation and people go crypto. So we're not talking crypto. I think it's really going from, you know, we went from paper to electronic. We're still stuck in the electronic era, right, of doing transactions. Now we need to go digital to give it speed, transparency, and what investors are looking for. Good data on capital allocations, on the impact that this will generate. But again, there's information asymmetry between markets, right? So anyway, there's just so much that could be done there. I think, as I said, it's not the lack of capital out there. I think there's a pipeline problem, but also an architecture problem or infrastructure problem. I don't know if, Niki, you see a little bit of the same with some of your fancy investors or some that you have to deal with that probably may be more educated when it comes to these type of instruments. Right?
Yeah, I mean, from obviously, like from UK perspective and from European perspective, you know, there's a bit more kind of harmonization. You would have seen it with the fragmentation and then you know, consolidation, what we're trying to do with certain standards and infrastructures as well, and also from a responsible AI perspective or digitalization, where we're tagging certain types of instruments. You know, ESMA, prime example, is doing a lot as well. And I remember being involved with the European Green Bond Standard in the early days and going to present on that, and now looking at the infrastructure and how that could be changing. There's a lot of movement happening, I think, but I just think echoing it, and you prompt my brain actually going back to taxonomies. Each market will end up having its own infrastructure built, but the transferability of that and across the different capital markets, I think, is really important. And I'll be really intrigued to see what the trade bodies might be saying or lobbying for on that as well. Because, you know, EU Green Bond Standard is one example. You do that, you can only operate, that's for the European market, but that then doesn't impact if you want to do, you know, green loans or green bonds outside. You then have to go back to the ICMA and LMA guidelines. So it's the interoperability of the markets and the infrastructure, I think, is we're still having the same. You do one where, you know, in Europe and UK, you then have to do something else in the US. So I think in the next like 3 to 5 years, there might be some evolution there, but I'd be really keen to see that accelerate because, like you said, Luke, the capital is there. You know, the LMA launched a report just over a year ago, like, you know, one of their insights reports showing that as well. But the accessibility and how we can allow that to be connected globally, I think, is something which needs some heart and a bit of thought about. So definitely, it's for me, similarly feels like a bit like an infrastructure problem too still.
Lovely. Thank you so much. Obviously, we're touching on so many different bases. It's absolutely perfect. So, Niki, just to build on that and what you and Luke have already mentioned, and obviously from your work with organisations aligning sustainability strategy with the financial decision making, where do you most consistently see ambition breaking down when it comes to real capital allocation?
Okay, honestly, from my perspective, it usually breaks down right where ambition meets real investment decisions. Most organizations today who I'm operating with for sure have strong sustainability targets. That isn't the problem. The challenge is that sustainability still isn't fully embedded in how capital actually gets allocated. This and I have this even in consultancy and sustainability teams where you'll have the strategy team, but then you'll have the treasury or the CFO and the investment team. The two actually inform one another because without the capital, the strategy is not going to happen. So the trade-offs generally appear and decisions often default to what looks either cheaper or more desirable in the short term, or the way which a roadmap might map out, but not underpinning on that part there. Apologies, there is a bit of building work going on today outside, so if you hear that, do let me know. A common example I just wanted to draw on, definitely in the last year since I've been at Bureau Veritas, and in particular working with different industrial sectors, is that projects, when we come to look at doing our due diligence assessments for sure, they're using traditional ROI models. So that's return of investment. And that doesn't always properly account for, say, carbon costs or transition risks. And on paper, the high emitting sectors and those high emitting assets, they can still come out at top even though they create long-term exposure. And if you compare that with companies, organizations using, internal or shadow carbon pricing, and Shell's a well-known example, for instance, that kind of mechanism, that helps to start steer capital towards lower carbon options. And then it brings sustainability, that transition journey, the decommissioning journey as well in other sectors, and the financial logic a lot more closer. And that's really, really important. There is a second layer kind of thing, I feel, from my view, which is around incentives. And you've got, the companies that are making a lot of progress in this, they're not just changing the strategy, they're linking executives' incentives to business targets. And we see this with sustainability linked financing as one example as well. And that's directly not just to the business targets, but to the sustainability performance. Schneider Electric is one example of many. But that's when you start connecting those incentives with the targets and the performance, that behavioral change starts to actually shift. And in the UK, obviously, in the UK here, we see plenty of strong sustainability strategies. But the market-wide challenge isn't just ambition, right? It's consistency, something we mentioned just a short moment ago as well. And it's about making sure every investment decision reflects that ambition. So it's not just the ones that are easy. You're actually really making sure it's focused. And there are regional differences too. When we look at Europe, the regulation is accelerating integration through tools such as the taxonomy, like the EU taxonomy, but then and greater alignment with disclosures, so our ESG disclosures. But then in other markets, like Luke was just talking about, there's more fragmentation and it's more uneven. But that can be shifted and changed through leadership, through the capital markets working with governments as well, to start changing that structure. And I definitely think we can learn as well from markets where good has happened, whether that's Europe and UK, for instance, to help developing and emerging economies, or and vice versa. Innovation shouldn't be forgotten. And I guess one thing which we're definitely also seeing is the use of responsible AI. And that's been used a lot more internally. And that's really to start helping companies, for instance, model their CapEx decisions while factoring in policy changes, physical risk, carbon pricing, for instance. And that also helps decisions to be more forward-looking. So I think there's, a change here going on as well. But in practice, going back to the start of the question, what we're usually seeing is stronger targets, smarter targets actually, but only partial alignment with the CapEx. So going back to my point before, it's really about that interconnection between the two. So the turning point really, I think, is when sustainability becomes part of the rules of investment, not just the strategy. For instance, when projects have met the emissions or the transition criteria to be approved, and the capital follows those rules much faster than say when it doesn't. And this matters because the capital gets misallocated, increases risk of, say, stranded assets, it delays the rise of transition costs. And I just think like that architecture is really kind of something we're seeing emerge and change to allow to help inform every investment decision more accurately. There's probably a lot more I can say, but I will stop there.
You were absolutely fantastic, Niki. And honestly, it's just wonderful to see so much passion and so much knowledge. So, Luke, I'm just going to come back to you for this one, as a lot of sustainable finance is, still designed at quite a high level. So, how do we better align financial solutions with the realities of the local economies and local communities?
Boy, that's my favorite question, that's for sure. and I think it goes back a little bit to what I was saying earlier and what Niki is also showing. And I'll come from it that the context of, we're part of the, it's called the Impact and Sustainable Finance Faculty Consortium, this group of university. So in the region, out of a few hundred universities, might be 10, 15 that are teaching impact and this type of new finance, thematic bonds and innovative finance, right? So again, there's a big gap. And a couple of years ago, we did a study, a capstone project with the university to start looking at, was there a knowledge gap? And if there is, why cities are not going to capital markets? To the cost of elections is just so high that they could go and these solutions could get to market, but it's hard for them to get to market. But so we looked at communities, the cities in Latin America as part of a capstone project, and we found that 98% of them didn't know nothing about innovative finance, didn't know anything about thematic bonds, and even how to get to markets, right? And even if they did, what we realized at the end is that most of them would have a very difficulties, so I'm thinking in Spanish, difficulties in capital allocations, again, in the use of the resources, right? So that they're efficient and well used and impactful at the same time, right? So at the local level, I find that getting to market is very hard, very expensive. And this is why we think digitization and regulated digitization is important, right? For transaction, to get people, to get cities and local communities a chance to get to market without having to go through all of these different levels. And we know it's very expensive and lawyers before you even get to a product. And you could be 2 years before you even get to a market, right? And I think the other one that you're seeing now, and the International Capital Market Association, ICMA, who would have thought that in 2026 now that mining is the darling of green capital, right? That
yeah.
Now that it's a whole different world. As I said, that 10 years ago, that mining or critical minerals, mining, sorry, in general, was not something that you would have in your portfolio, right? And now we're doing a lot of work with the energy sector and the mining sector, for example, that here in local communities, right? And there's only 2 mining companies that have issued sustainable bond and thematic bonds, even though now that ICMA have opened the door for green minerals.
Green enabling, yeah.
Exactly. Thank you for filling the gap.
Talking about it this morning.
Exactly. So it's there, but we're having discussion with the mining sector says, we do good things. We want to do good things, but they just don't know how to get the capital markets. I mean, their game is equity, right? So investors come in, it's an equity game when it comes to critical minerals, when it comes to mining. What do equity investors want is get more stuff out of the ground. I want to get out of this as soon as possible. So again, again, the knowledge gap for me is the biggest challenge or bottleneck that we have. Infrastructure is the other one. The smaller deals, right? Again, I can give you many examples. We had discussion last year with the European Investment Bank, and I bring the challenge that we have in Latin America and Africa when it comes to getting deals to market. And the European Investment Bank says, look, we just need to go to northern Italy. You'll see the same problem, right? And you see the same problem when I go back to Canada, the same problem with some of these remote communities. None of them have issued bonds. None of them have looked at this market. They're extremely hungry for these type of deals, right? But right now, it's the lack of ability to get to market. So you need some kind of a third party or group of third parties that will get you there. It's very expensive. But now you can digitize all of these processes, right? Again, so blockchain is not the panacea as well. I was going to say tampoco. But it's a good tool to have, right? That will connect market, will connect investor, will give it more transparency, will give you a space for a discovery price, right? Right now, so there's no discovery space right now in these capital markets that we have here, right? So it's a project management, you go to market, but again, is it priced at the right price, right? So there's all kind of little things that are needed, but again, the capital is there. ESG used to be, more of a kissing frog, hugging trees type of thinking but now it's risk management, right? In your portfolio, if you're not doing it, then you're missing or you're at risk. Mm-hmm. Yesterday we just having discussion with PNB. PNB Paribas, and you're just looking at the exposure in their portfolio on mining, but just the tailing facilities, the liabilities that they have on their portfolio, right? So the lack of or data, right, that really can investors can understand what they're getting into, right? So again, yes, opportunities, but again, we need better tools, right, for investors. If we need to speed, I think is where we need to go now, because time is not on our side. So.
Absolutely not, Luke. I 100% just want to echo that point. It's the accessibility, the transparency element, and having tools to enable that to be scaled and accelerated. Because, like we said at the very start, capital is there. It just needs a slight tweak in the architecture, I think, is what we're both saying for sure.
And I think, just to add, if you allow me, I think the other one is everybody wants the investors in the room to actually walk them through and get them through the 2 years, right? But most investors don't give it to me simple, right? What's your investment theory? What are the impacts? Can you measure them? Can you report on them? And I'll buy it, right? As simple as this. But right now, everybody wants to. I think the products, right? Nature finance, biodiversity, they're complex. What's the business model behind it? And people, the environmental sector will say, well, there's no business in nature. It's part of this, and we need it, right? But again, it needs to be sustainable in all ways. It's not charity, right? We're talking about investment. It's your pension funds. It's your personal investment, right? So again, we need to rethink the model. I think it's possible. They're sustainable, and we're working hard right now with the mining sectors to help them nudge over, because the capital is there and we need them. But again, we need better rule and more transparency. So,
Perfect. Thank you, Luke. And can obviously tell that is your favorite question. The depth was incredible on that one. So just to sort of follow on from that, Niki, obviously we hear a lot about transition plans. So in your experience, what are the defining characteristics that will distinguish, a credible, investable transition plan from one that remains just very largely aspirational?
Yeah, I could 100% go on for this for a very long time, but and also because it's a very relevant topic at the moment. But for me, the difference is whether the plan feels like a working financial blueprint, or mainly a communications exercise. And if I just take kind of connecting back to the investor perspective, what we were looking at, right? They really want to know simply like what's actually going to change, how much is it going to cost, and what does that mean on returns and risk, like Luke was just pointing out as well. That makes it investable if they can answer through those parts. There's obviously more detail to touch upon as well, but the clearer those answers actually are, the more confidence the plan is going to be, and it's going to be more convincing for investors to go, yeah, absolutely, we've got it. And good examples really are Hutson. They stand out because they wanted to break the decarbonisation down by plant, and that was really exciting, right? Because it then was linking specific technology, specific investments, aligning it with financing, and that level of detail matters because it means it's not aspirational. It means it's investable. There's clear communication there, clear returns, clear risk, which has been sought into. And another kind of example, just to kind of help contextualize from something being aspirational, is Maersk as well. They've been very explicit about fleet transition, the fuel choices, the timing, and it just makes it easier for investors to really assess the execution risk. Because I think we forget sometimes that people have to operationalize this as well. Like the companies have to do something about it. And the reason why I'm touching upon these as well is, it removes it from just being aspirational, and we're still working on what makes a good, credible transition plan. I have literally for the last 2 years had the same conversation each time I've been sat with at the corporate disclosures conference too, and we're getting better at it. I think we're definitely getting clear and aligned as an industry, so we're all using the same kind of guidelines and tools here. But also, in looking at it from a UK side, okay, just to bring that to life as well, the credibility, well, you'll see more credibility where the targets are also linked to clear governance. Another element we sometimes forget in the E, S, and the G, but also the future of business models. And a couple of examples of Rolls-Royce, they're kind of moving in that direction. On the financial side, you've got the likes of HSBC, and they're increasingly tying like transition planning directly to financing strategies, how they're looking at their issuers as well. And that all helps to address risk. It means things like, the plans can be more investable. But what the best plans do differently, right? They're not just talking about, we're going to do this by 2050. They're showing what's going to happen in the next 3 to 5 years. They're making it measurable. So going back to that point me and Luke were talking about earlier, connecting it to data, making it measurable, making you're able to like monitor and evaluate this. And from our perspective at Bureau Veritas, those strongest transition plans we've been seeing or supporting on clients to help develop are really build on solid data, scenario analysis. It's been integrated into financial planning, so remembering to bring that along. And it's also importantly owned at the board level as well, and the executive levels, that C-suite levels, really center and focus here. And there's honest conversations about trade-offs and uncertainty. And this I find really exciting, particularly in those hard to abate and decarbonize sectors who need that help. And investors from those we've been speaking to as well, like they're typically more comfortable with plans that acknowledge uncertainty than those which look perfectly smooth. And that really matters because it's really about testing how those plans hold up under different regulatory market scenarios too. It's all that context which matters, like Luke was also talking about earlier. But it's also being comfortable to test different assumptions, and that I think also with the support of maybe responsible AI, like it means that those plans which can be then connected to capital allocation, to credit decisions, to insurance as well, all of that can be looked at. So if I'm going to sum it up, hopefully in a succinct way, it's not about how polished plans sound, right? It's about whether someone can realistically invest behind it. And I think when you start looking and thinking it in that way, that's when it becomes more meaningful.
Perfect. Thank you so much, Niki. So flowing on quite nicely from that, Luke, is your final question, thinking in that realm of change and scalability. There's obviously increasing pressure to scale the sustainable finance quickly. Do you think that we are scaling solutions effectively, or are we just overlooking deeper structural issues in the process?
I'll go for door number 2 when it comes to the process. And again, I don't want to sound like I'm repeating myself, and maybe I am in some ways, but again, I think we need to go digital and regulated digital as soon as possible. And it's what we call democratizing access to finance at the end of the day, right? So again, if you look at, for example, just give you an example, 524 public development banks around the world. I mean, all individually smalls, right? $24 trillion in assets, about 10% of the global capital. And again, none of them interconnected, right? There's no interoperability for them. There's no marketplace for them to issue, right? Most of them will need to go to a JP Morgan or a Goldman Sachs or find some kind of issuers for them, right? But again, some of them have that capacity. But again, to get to market, it's extremely expensive and long. And again, Kenya issued a green bond about 2 years ago. It took them about 2 years to get to that. And it was a paper exercise, just a real traditional electronic presentation of the green bond. So now they want to repeat the same thing. They'll have to go through the same step, right? But now what we've done, the work that we've done with CAF, regional development banks here, we looked at the whole markets, right, of PDBs in the region. And if you connect them and give them access to a market where they can issue and don't need to go through these lengthy process, where you need an IDB, you need a CAF, you need a multilaterals, or you need a corporate to do these, right? So again, democratizing access to markets. So again, it's not just these big bucks that can get the market, but again, cities can get the market directly, right? And, again, if they follow the rules and regulation, and this is what we did with these platforms, is bake in the capital market regulation, so make it easier. You don't need to think twice. You don't need these lawyers, so that it will walk you through to issue a bond and all the process that needs to do. And you got your template, and you can reissue under that template. I think the other ones, and I think Niki probably knows more on this, but I think there's two companies that are a good example for me, Walmart and IKEA, and when they decided to look back in setting, right, within their own value chain, says we want to create that change, so we will go to market because we have the capacity as a corporation to get the markets and get the big size and get a low cost of lending, and then lend back to the SMEs in their value chain. And within, I think, a couple of years, actually met over exceeded their targets that they had when it comes to decarbonization their value chain. IKEA did something similar. Again, we need more corporations to think value chain, right? Sustainable value chain. But who will issue these bonds? Because SMEs, as I said, in emerging economies, there's not that many big companies. This is why the marketplace are small, right? So they don't issue that much, and who will trade at the end of the day, right? So again, you need these pooling facilities, right, where large corporations are doing it. So one of our partners, the World Business Council for Sustainable Development, and we're talking about sustainable value chain. But now it's more of a reporting exercise than a getting to market exercise, which is what we're trying to get them to think, right? Reporting, I mean, beautiful, right? The scope 1, scope 2, scope 3. But once you know this, how do you get these things to markets? Because markets are looking for these instruments, right? These type of things. But you need these pooling facilities. You need to aggregate some of these smaller, and you can de-risk your portfolio as well, like this. So we need more innovation, I think, and speed. Again, I repeat myself. I think digital. You see the big box, BlackRock and JP Morgan and Fidelities and some of these other ones have already gone there, right? And they've got their back end. But again, they're not going to give it to you. They're not going to do it for free. Right? At the end of the day, they'll be the same type of fee levels and getting access. Or we're saying these platforms now could be made available. They could be regulated. And that's the discussion we're having with capital market regulators here to make it more accessible. Right? Democratizing access to finance and speed is what we need.
Yeah, and I think as well, with some of that, it's around, the discussions around tokenization and blockchain, like you mentioned, and DLT, which are attracting more attention. And it's, there are certain parts of the markets which are like digitalized, but these elements, like to kind of drive alignment and drive access as well for SMEs, is key. And I've just seen a question up from Felicity, which I think leads nicely onto that discussion as well, Luke. It's about breaking rules down quickly and unifying them worldwide. Huge question. So I'll only touch upon part of that. I think it's less about breaking the rules down, but about understanding and getting the right stakeholders together. So that'll be like the trade bodies like ICMA, LMA, and so forth, along with the kind of the lead regulators, like we've got the FCA in the UK, you've got ESMA in Europe and equivalents, and actually going like, what is it, what the market needs, and how can we create that infrastructure, and where's that investment going to come from? Because that's what will allow the interoperability. Oh, been trying to get that word in all day. The interoperability part.
Exactly.
But maintaining the credibility potentially. But Luke, I don't know if you can elaborate on that a bit more. Just a part of it.
Yeah, no, it's interesting. If you look at IGMA, right, there's about a list of about 300 digital bonds that have been issued, all of them trying to prove something, right? Speed, reducing cost, getting to new investors. But none of them are looking at this on their marketplace approach, right? More of this interoperability that you just mentioned, Niki, that is important between markets, right? And this is where we need to do, but there's still a lot of conservative, and it's hard to make that change, even with, speaking to different stock exchange here, you need to go digital if you want to attract new investors, right? To come in and go out, and they can go and trade tomorrow within the same day, within a few minutes. They can go on Luxembourg Digital Green Exchange and get these tokenized. But again, we people have to understand the difference between crypto and regulated digital assets. I mean, these two worlds, but
very different meanings.
Yes. But again, the crypto world, $750 billion sitting there in some kind of coins for the lack of products, right? Investors are looking for this, and the not the institutional, but the retail investors are looking for products right now. They're hard to find.
Yeah, and then obviously it begs the question of cybersecurity. But if I just think about what we've kind of both just said there, and if I understood correctly, maybe to try and help give a little bit of response as well there, Felicity, if we've answered it in some way. It's the direction of travel. Like, I think capital markets are are becoming more automated and data driven, and there's more distribution going on with tokenization, digital assets, but the institution centric nature of it and how that interoperability can work, partly also because of regulation, right? Let's not forget that different markets also operate in different jurisdictions, so different requirements. So that governance element needs to be part of the technological solution, and the stakeholders also need to be in the right place to allow that to be convening. But I think it's exciting times, and I just going back to my original point, I think over the next few years we'll start seeing some smartening up of the system as well, potentially.
Perfect. Well, thank you, Niki, and thank you, Luke, for what was, I can only describe as an incredible discussion. We touched on so many varying areas of sustainable finance and green investments, and it was just deeply insightful myself, and I hope the audience also enjoyed it. So before we wrap up, I would just like to give the opportunity to see if anyone other than Felicity would also like to ask a question. Obviously, if not, if you would prefer to reach out to one of us, probably Niki or Luke personally, obviously do contact them on LinkedIn or contact them through myself, and I would be happy to put you in touch with your preferred speaker. But also, as Felicity's question was so broad and so wide, we will only have time for one more.
Should we go on to Felicity's question? Oh, I have another one.
Oh, here we go. So from Colleen, can you envisage how digital transformation could look?
Well, I think right now, for me, the bottleneck is the market regulators, right? And we did this in Colombia and in Latin America. We met with all of them, and as soon as you mention again digital, then people go crypto, and they say no, there's another side to this, and there's companies or issuers in the U.S. that are, I mean, they have to comply with the same Security Exchange Commission rules. Same thing like any issuers that they have to do, right? But except there's more transparency, and your response are instant, right? When you So again, the technology exists, the infrastructure exists, and I think it links into Felicity's question as well, is what we did is actually baked in all these the capital market regulation rules and the taxonomies in the marketplace itself. So it's a no-brainer for investors to actually come into Colombia or go into any capital markets, because it will force you, right? You need to report under the green taxonomies, and in Europe, you need to report on those EUDR or SFDR or whatever other acronym there is out there.
They keep growing.
Exactly. So again, digitization can help simplify the process, because it's hard. I mean, it's difficult to know what do I report on, and if you miss, then there's all kind of problem that comes with it. So digitization, I think, is the way to go, and it's happening right now. I think we need to go beyond the proof of concept. It's been proven. You can go to IGMA right now and find all of these digital bonds and successful bonds, right? I mean, it's just phenomenal what you can see there. But again, it's really focused on, again, not scaling up, but proving that what you're doing is right? So,
yeah, I absolutely echo that.
Perfect. Well, thank you guys so much. And obviously, thank you to both Colleen and Felicity as well for asking such engaging questions. So as we come to a close today, I just want to say a massive thank you to both of our speakers for sharing your time, your insight, and obviously your incredible knowledge on the subject. I would also like to give a massive thanks to everyone who has joined us today. We and myself here at Go Green Now, we really do appreciate you being a part of that conversation. And then we will round off with a final thank you as well to our media partner of Trade Finance Global for supporting this specific session. So if you would like to stay connected or continue the conversation with Go Green Now, or obviously any of the professionals we've had here today, Our contact details will be on the screen, so do feel free to reach out to us. We would absolutely love to keep the conversation going and have you involved in future sessions. So thank you again, and I hope you enjoy the rest of the day, and we see you all again soon.
Thank you again, Ella. A pleasure meeting you, Nikki. And
Thank you,
looking forward to more conversation.
I know, we'll definitely be talking again. Take care, everybody.
Thank you. Have a great day.